Well, thank you all for being here. Thanks to our panelists for being here. We'll do a round of introductions, but just to quickly kick it off, the reason I wanted to be on this and be a part of this is because I think payments, to me, is one of the most, if not the most fundamental use case of blockchain technology, dating all the way back to the Bitcoin white paper, right? And we've seen that evolve in a couple of different directions. I mean, it's interesting for me because I think it sits right at the intersection of being infrastructure as well as an application, right? A fast, secure, cheap, programmable money layer has allowed a lot of use cases, first in and of itself as a payment rail and stable coins and all the things that enables. But also when we think about DeFi, DePIN, even AI, streaming payments, things like that, it's really opened the doors for so much of what we see in this space now. And I think we're really only scratching the surface. So with that, I'd love to go down the line here, and if you don't mind giving a quick introduction on yourselves, and also any perspectives that you have on what makes you bullish on this space, or even bearish. Yeah, I can start quickly. I guess I probably should have gone first. I'm Bala Varadhan, part of Avon Ventures, which is a crypto Web3 blockchain-focused venture fund that's part of the broader Fidelity investments umbrella.
All right, my name is Tracy Lee. I'm the partner of Istari, right? We're the host today. As I mentioned, we specialize in investing into the payments vertical. A few of our relatively well-known investments are Transact, like Bitwave or Magic. Quickly on my personal side, I spent the first 10 years in Silicon Valley as a founder and also building for tech startups, and then went to Coinbase and Circle. Right, my Circle journey building payments product really made me a strong believer why today we're sitting here want to invest into these visionary founders.
Hi everyone, I'm Joshua Rivera. I'm one of the partners and general counsel at Blockchain Capital. Blockchain Capital, venture capital firm. We've been around for over 10 years. We've invested in about 170 projects and portfolio companies, and that's across 7 funds. We're investing out of the last 2, an early stage and a later stage. We manage about 2.6 billion in assets, and we do crypto exclusively. Been doing it for a long time. It's a lot of fun. I think I have the best job that a GC can have. I'm unusual in that I sit on the investment team, which like normally if you are a lawyer at a venture firm, you're like in a back room somewhere doing lawyer things. And so they promised me that they weren't going to do that to me, and they were good on that promise, and so it's been great. We major heavily in infrastructure, and so we've been investing in payments really, from day one. But we have investments in Circle, also Bitwave, kind of. Early on, did some things with like MoonPay and things like that. So we've always kind of taken an interest in this part of the space. I think it is a natural part of what we are building, which are decentralized ecosystems of value exchange. And you need to kind of like end with how does that result in payments? And so I think we are generally bullish. We're excited about being part of the infrastructure of the space.
Awesome, thank you. Glad they didn't stick you into an alley somewhere.
Me too, yeah.
I know, yeah. All right, so my name is Boris Revsin. I'm the managing director and CEO of Tribe Capital. Tribe is Menlo, New York, Boston-based venture firm. We actually started off in 2018 as a quantitative-focused venture-specific firm. We didn't do a lot of crypto. At the time, I was at Republic running our venture group. Our funds are kind of consistently 400 million, so we always do sort of lead, seed, Series A investments. But then in 2021, as I started to get to know Tribe, we started doing more and more work in what I'll call blockchain, not core crypto. So we invested in Kraken, we're on the board. We invested in MoonPay, TaxBit, started to get more familiar with some of these, call it like in between fintech and crypto. And then I joined in 22 to lead our crypto practice, and I think we're probably one of the few traditional venture funds that promoted the head of crypto into a CEO role. I don't know how often that's happened. So obviously we're leaning in. And then on the crypto side, we do everything, tokens, equity across the board, really looking for creative founders with large markets. Just to your question originally of why we're excited about it. The last 2 weeks even have had enough things to be excited about. Obviously with Joe Biden starting to move a little bit further into like actually opening up the narrative, it's been exciting.
Do you hold Biden?
I'm not answering that. I didn't. Sadly, my lawyer is in an alley somewhere. But
Most of them are. Don't be sad.
I'm going to tell Matt. I'm going to tell Matt. He's going to have words with you.
We're used to it.
Let's see. The ETF, 27.5 million and counting stablecoin users, hundreds of billions of dollars of value exchange. I mean, this is a real thing. There's no putting the genie back in the bottle. BlackRock's tokenization efforts. I think we're at the beginning of something that's going to make crypto seem a lot more real. And the intersection of us knowing Web 2, sort of the core Web 2 categories, AI, healthcare tech, payments, fintech, intersecting with crypto is just super exciting to us. So we're obviously leaning in.
Thanks, guys, and happy to finish this off here. I'm Cameron Coombes. I'm a vice president at Whitestar Capital, focused on our digital asset fund. At Whitestar Capital, we invest across 3 strategies. One is a traditional tech, and one is the digital asset fund. And the thesis for the latter has always been that those 2 worlds are going to come together. And I think that that is nowhere more prevalent than the conversation that we're having today. And we're already starting to see, with some of the adoption numbers that we mentioned, 100 million addresses holding stable coins. I think over 2 million that have been active in the past 24 hours. The genie really is out of the bottle. And I draw back on my prior experience as a banker, where I was shoved in the back room, unfortunately, was not a general partner at the time, to really see that this landscape has evolved significantly, both with equity and with tokens, of which we like to invest in both. The last thing I'd say is I spent my previous year prior to joining here at Consensus, where we sat atop the largest consumer and developer product within the broader crypto ecosystem. And getting an understanding of how the average user was using MetaMask was truly enlightening to me. And all the more has driven my conviction that the future is crypto and is blockchain. And it's far more than just a technology. It's more a cultural movement about how people want to preserve ownership of their everyday digital life. And I think the core nucleus for that will be payments, and hence why I'm so excited to talk about it here, also in my home city of Austin, Texas.
Yeah, perfect. Thanks so much, Cam. I'm going to go right back to you, actually, because I think you brought up an interesting point in terms of the types of use cases that payments as a programmable money layer are starting to enable. Would be curious to get a sense of, in both directions, historically, what's been the premier use cases that you all have looked at, but moving forward also, is it more of the same, or are there new avenues that you're starting to see these expand into?
Sure. So I think we try not to reinvent the wheel when we think about the broader payments investment thesis and landscape. So digital payments is the largest fintech market. It's over $8 trillion. And I know that we often cite that there was $7 trillion settled on chain or some number like that between MasterCard and Visa. But the reality of that is a large majority of that activity, I would say over 90%, is not going to be specifically focused on payments, right? Like that is going to be a lot of trading related activity, not stuff that is specifically based on me paying Bala or me paying anyone else on this panel. However, the 2 things that I would note there are $6 trillion and growing is an absolutely massive number, and 10% or 5% of $7 trillion is also a massive number, especially when you consider that it's growing. So I think we like to look at payments from that first principles view, that any application that is leveraging the power of the digital form factor of stablecoins is something that we will consider and look at. As it relates to specific use cases on top of that, we think that the core evolution of payments will look a lot like fintech. Why did fintech win and innovate on the traditional banking experience? Because it was a better user experience, right? My girlfriend talks about SoFi all the time. If I bring up a fintech in front of her, she'll literally start scrolling through TikTok right away. But ultimately, we think what we get excited about in the morning is people who are using these payments products but building real experiences around them. So whether that's using a Bitcoin-backed stablecoin, and Bitcoin is the core nucleus of your banking app, where you spend in Bitcoin or you spend in a Bitcoin-backed stablecoin, it rounds up, it goes back and reinvests in a Bitcoin. We're doing a lot of the same things that we did with traditional fintech, but we're doing it on these new rails that we all collectively own and can benefit from. So beyond that, I think the point that you mentioned earlier on the programmability of stablecoins is obviously exciting to us all. We've invested in a company called Superfluid, who is specifically focused on that, and we're very excited about. But ultimately, again, we are very much focused on taking that core form factor of a stablecoin and investing in the companies and products that are building experiences, both for consumers and developers, around using it. Whether that's peer-to-peer, whether that's cross-border, whether that's B2B2C, we don't really draw a distinction. We just want to continue to invest in companies that are building the best experiences on both sides of the aisle.
Yeah, it's interesting you mentioned the dichotomy between what you've seen in traditional finance and payment rails there and what we're seeing here. Would love to get any thoughts, and a lot of you have invested across both. Where does that analogy make sense, and where does that analogy start to break down, especially when you think about it from an investing lens?
Sure, maybe I'll go first and pass it to you. So we think about, especially when it comes to payments and stablecoins, we think about it from the perspective, we have this portfolio of companies. Some of them are really big, like now billion-dollar companies, some of them are a lot smaller. A lot of them are always searching for efficiency and unit economics. This whole AI conversation has really spooked a lot of founders because they're worried someone's gonna come across the lane and just cut them off because they need 10 times less people than they do. And so everywhere, especially our fintechs, whether it's in the US or outside the US, are looking for efficiency gains. What we've told them consistently, don't put the word blockchain, don't start an R&D team, like don't do the stuff that was cool in 2018, 2019, 2020, because most of those things died. They never got the buy-in of management team. Find a massive problem that you actually have and just make it a core project for you. And so we have this company in LATAM called Capital. They're a neobank. They are just like, we're spending a huge amount of money on settlement. We want to do this in stable coins. It's easier for cross-border. The regulatory landscape in LATAM makes sense for us. We're going to do this, saving hundreds of thousands of dollars every month. Already makes sense. So for us, we're thinking about it the same way as we think about AI. Don't tag in .ai at your domain name. Don't build an LLM company. Like that doesn't make sense. Instead, incorporate it into your existing roadmap and make it more economic and efficient for your actual business. And that's how we're thinking about it. And all fintechs can leverage stablecoins, whether they're doing it now or later. It's just gonna depend on how bought in they are, but they will get sideswiped by the fact that the market's getting bigger, it's getting cross-border, and the regulatory landscape is opening it up. So more for us about integrating into existing Web 2 companies.
Yeah, I mean, not a whole lot to add. It was a really good summary from both of you. I think you think about traditional finance and payments, you think about endpoints, right? It's like, you know, like where am I getting something from? Like I'm interacting with a merchant, they're giving me something, I'm paying them for it, right? And then, so I think like when you think about payments in a decentralized ecosystem, you can think about it in that way. And I think that's kind of where there are parallels to traditional finance. I think where it breaks down is just you look at, and this is largely the story of crypto, is like you look at the just like massive layers of intermediation that happen in traditional finance to make payments happen, right? And so you have, you know, you've got like banks for each party in that transaction, then those banks have to talk to like other financial institutions, and they have to like all, you know, verify and cross-check ledgers with each other, right? All of those things add inefficiency, add cost, right? We are paying people who sit in between transactions, who basically like take rent to facilitate these transactions. And I'm not a payments expert, but I have friends in the industry, and we look at it like it is extremely complicated, right? If you're just traditional payments, not talking about crypto, like it's just extremely complicated. And so I think the analogy begins to break down very quickly, because what we're trying to do is we're trying to create a much more efficient ecosystem, right? That enables the same end result, right? That like you are getting something in exchange for value, right? But doing it in a way that leverages technology, decentralized technology that enables disintermediated transactions. And so for us, that's really important to kind of like step back and see this really big world of payments, trillions of dollars, as a beneficiary of kind of the broader infrastructure that we're building in the crypto ecosystem.
Tracy, I want you to answer this too, but I want to add a little bit more for you specifically. Given your background at Coinbase and Circle, you've seen a lot of the evolution of what payment technology has been from the early days to what it is now. And obviously, Istari is sitting at that intersection of TradFi and crypto and fintech. Where are you seeing infrastructure needs to be built more versus now we need real applications and things that are disrupting things like B2B payments, remittances, et cetera, those bigger meaty use cases that we're starting to do, but we still have some work to do from a crypto perspective, right?
Yeah, great question. So I think from overall perspective, the things we invest and how we look at our investment is we look for companies are actually solving a real use case. a lot of them does fall into kind of the traditional fintech's perspective, right? Like a B2B, peer-to-peer, cross-border, or payouts, payroll, that kind of stuff. But I think there's a nuances coming from blockchain technology is the infrastructure layer is slightly different than what we have in traditional, banking system, right? Because the programmability of blockchain is providing we've never seen that ever existed before. So, for us, right, we're looking at on the application layer, but also on the infrastructure layer. So for technology-wise, because of a lot of payment companies do use stable coins, which, for example, right, USDC have to go on blockchain, but there's different layer 1s or layer 2s. So we've been seeing new companies are innovating in this space, right? Like Bridge.xyz, right? They're bridging in between different layer 1s, layer 2s. We recently also have a portfolio company called Moonwell. They developed a new technology that you can burn USDC on one layer 1, let's say, convert it, and then mint again on a different layer 1 or layer 2. So one of the benefits is preventing hacking during the bridging, process. So from our perspective is the technology on blockchain also need to catch up to support the new, applications are building. So that's kind of what we're seeing. We're also looking for brand new infrastructure deals and APIs to solving that problem, to bridging the gap so we can really accelerate how blockchain can solve all the payment system from, all different links, transfer money from A to B.
Yeah, absolutely. We've the same thing here. We've seen that sort of dichotomy, but I'd take that even a step further. You have the payment rail aspect, but you also have, and Cam, we've talked about this in the past, is stable coins and payment rails and crypto allow you to be your own bank in a way, right? There's the yield aspect of it as well. Unfortunately, that's led to some regulatory issues. So I'll turn it over to our general counsel and pick on him a little bit. You had a recent interview, I believe, with Hester Pierce from the SEC, right? Talk to us a little bit about that conversation and where you've seen progress and where you see gaps that need to be addressed.
Yeah, so as Boris mentioned, we've had a really great kind of last few weeks in the industry where we've seen a lot of political movement in crypto. So I'll just start with that as a backdrop for the 7 years of pain that I've endured on the regulatory front. I got interested in crypto years ago because I started to do research on Bitcoin and Ethereum and felt, wow, what we're building here is actually uniquely different from a technological perspective. And from a regulatory perspective, this shit is from outer space. It is just so different, right? And the reason for that is, as I mentioned before, what we are doing that is fun, people are like, there's nothing new under the sun, which I generally agree with, but the last several thousand years of our scaling of economic and finance and commerce transactions has come via a great a great innovation called an intermediary, right? How did you transact with somebody that you didn't know in a way that you could be confident in the outcome of that transaction? Well, you would go to somebody that you trust and that other person also trusts, right? Intermediaries aren't inherently bad, right? We've used them over the last several thousand years to enable us to achieve global commerce. But there are lots of problems that come along with intermediaries. And more importantly, we now have technology that enables us to disintermediate. That's great. But here's the problem, is that along with the kind of rise in prominence and sophistication and necessity of intermediaries, we have created regulatory frameworks that map directly onto that paradigm, right? So now we have regulatory frameworks that require intermediation, right? So regulators love intermediaries, right? They're like, where's the intermediary? And I'm like, well, there's not one. And they're like, I don't understand. Tell me where the intermediary is. The reason for that is because, well, intermediaries are a place where they can go and be like, hey, what happened here? They can get information. It's also a place where they can constrain, right, or kind of open up economic activity, right? So if they want to control what's happening in that ecosystem, they can pull levers on the intermediary to affect how commerce happens or economics happen. And then finally, it's a place to blame, someone else. Like, what happened here was their fault, right? The intermediary. So the strong preference, it's like innate in a regulator, is that they regulate systems via intermediary. But that is not what we are building. We are not building that. And so genuinely, when you go to a regulator and say, I am trying to engage with you in a system that is disintermediated, it's like speaking a different language. And so that has been the pain, right, is that our regulatory frameworks aren't built to address the things that we are building in crypto. And what that means is we need new regulatory frameworks. So last week, FIT 21 passed the House of Representatives. It's really amazing. Now, there are lots of issues with FIT 21, and that's a conversation for another time and probably alcohol. But it is incredible that we have had what effectively is a referendum on crypto as an industry pass out of the House of Representatives with like 270 votes, something insane, right? Largely like bipartisan. I think there were like 70 Democrats that voted for it, which is amazing. So that's kind of the type of progress that we're making. But the challenge now is how do we actually build appropriate regulatory frameworks to address systems that we have never had before? That's hard.
Yeah, absolutely. I want to switch gears a little bit, given that we have 4 amazing investors right here. One thing that's been interesting, we've been investing in this space since about 2017, 2018. At that time, we focused largely on equity investments. Now we look just as equally at equity or token-based investments, and I think a lot of other firms have also come along that journey over time as well. But uniquely about blockchain payment companies is that they're often equity-based as opposed to token-based from an investment perspective. How do you think about that dichotomy, especially when you think about value accruals and returns and everything that comes from making an investment from a structural point of view?
I'd be happy to start here. Yeah, Bala, you and I have talked about this at length many, many times, definitely have some strong opinions. A lot of times you'll hear venture capitalists talk about the power law or venture math. And essentially what that means is a lot of the companies that you invest in are going to fail. So the ones that you win with, you exit at some point. You need to win big, right? You need to make the fund, you need to return the fund multiple times over. And there's always been a perception within crypto, and the data has certainly validated this, right? That exiting via equity is much more difficult. And thus, more recently, and I won't go too deep into the details because I'm sure that we're all well familiar with this, there has been an argument about, all right, should we even invest in equity or should we only invest in tokens? To Bala's point, historically, a lot of payments companies are equities. So a few things that I will say on that venture math point, which again, if you hear a VC talk about this, ignore them. They're going to ramble to you for the next hour. On the equity side or on the token side, winning VC, winning investing, and winning building a big company is all about picking the companies that matter. That doesn't matter if that's a token company. That doesn't matter if that's an equity company. You need to be in the companies that are going to be the Coinbases of the world, soon to be hopefully the Circles of the world, which I'm incredibly excited about. And ultimately, in that respect, the token versus equity argument is more, can you structure a network on the token side that benefits from a token and shares in the economics of that token and creates utility based on that token? That does come with the added benefit for early liquidity for investors and early insiders. But ultimately, I think that's more of a design choice for the team and the specific product they make, and whether or not they can create a network that is value additive based on a token. I'd say secondly on that, ultimately when we think as investors about equity versus tokens, again, you're always going to be thinking about your exit. On the equity side, there's an argument, it's cash flow driven, you're going to exit via an acquisition, you're going to exit via an IPO, et cetera, and the acquisition market is seized up. I was a banker in 2021, miserable 2 years, very busy, but ultimately I don't think we're going back to that, but I don't think that's in crypto. I think that's a microcosm of a broader experience in a regulatory movement towards less acquisitions, less monopolies, et cetera, which I think everyone in crypto would espouse as well. So in that respect, I think there is also a lot of merit for going the token route as well. But again, I think it's really just going to be a founder choice, and can you find an effective way to structure your company? If you're going to launch a token, at some point, my belief is that there's going to need to be some fundamental reality that token is grounded in. Who's going to buy that token when you're exiting at some point? You know, what are they going to underwrite when they write it? Are they going to underwrite users? Are they going to underwrite cash flows? How are they going to make their decision? That's how we look at that landscape and that bifurcation. And ultimately, again, it's a founder choice in our opinion.
I think you covered a lot of interesting points. We've done this analysis. We wrote a paper actually to our LPs about tokens versus equity, because all of our LPs were asking about where should we be investing. We're so nervous about tokens, but there haven't been any exits on equity. If you actually look at it, there's basically been Coinbase, some Bitcoin miners. Like, it really hasn't been an active IPO space. And to your point, with the current regulatory environment, big acquisitions are hard to get through. And so you really have to think about these things in a very long-term horizon if you're investing in equity. That said, I've found that teams that value the equity, the proprietary nature of what they're building, are a different breed, and I think that they're really able to incorporate their business into enterprise. They're able to work with other companies. Much harder to do that if you're pseudo-anonymous or you've got a token and you've got a market maker and all this stuff. So I think the sort of long-term horizon, the pendulum will swing, the regulatory stuff will open up, and there will be 5 massive equity-based companies, and you want to be in them, no question. Maybe 10, who knows. On the token side, where we do spend a lot of time, that's been a harder challenge, right? Because you get equity and tokens, and there's this question of where the value accrues. How are you a fiduciary? Can you take a board seat when they open up a foundation? I think all of these questions are still up for debate. And I think that the reason people are pushing towards tokens now is because there have been exits, even though most of it's on paper. Everyone's been locked up for a long time and will be locked up for a long time. So tokens aren't just the free ride. Maybe your IRRs look good on paper, but you actually have to send the money back, and that's when your stuff unlocks 2, 3, 4 years later. So for us, we are investing in both. We are doing mid and late stage, so like later, larger checks when it comes to equity, and we're doing many smaller checks when it comes to tokens, knowing that there's still a lot to figure out. And that's kind of how we've decided to wait and see what happens on the regulatory front.
Yeah, I mean, we do both. And I think just one important point is doing both in each deal. We do both in each deal, right? So we invest in equity and tokens in each deal. And that is great because it actually enables the founders, the team, freedom to say like, hey, like we're like working this out and we realize that value is actually going to accrue to equity here. Like a startup does not, the line from start to success for a startup is not straight, right? It's very loopy and sometimes like crazy. And so the ability to iterate and have flexibility around where value is going to accrue is really important. I think there's lots you could say about the difference between kind of equity as a value ecosystem and tokens as a value ecosystem. But what is important is that we are investing in companies that want to be valuable in some way, and the distinction between equity and tokens is about like understanding how that value is going to best accrue in which vehicle via what avenues. Don't have a token just to have a token. Have a token if it is meaningfully valuable to an ecosystem that you are building.
Agreed with all of you guys, and then we've talked about this, even before off the stage. We also do both equity and token investments. We don't really discriminate. I think for us is, in the past I mentioned this, it's slightly a red flag for us looking at payment companies are launching a token immediately, right? So for us is, how is your value of the company is gonna tied up to? It's gonna be to your token price, or is actually the equity of, or the growth of the company. I think, however, we're recently seeing a trend, or maybe some founders been evaluating different ideas of launching tokens, right? We've been heard there's some governance token ideas being brought up, or maybe some security type of tokens, in addition to the equity side of the company still running. So I think we're still, early in the payment sector. A lot of new things might be developed in the next several years. maybe there's a new way or new structure we can look at payment companies in the future. But overall, we are more bullish on the founders who are very driven, want to build a company, doesn't want to do a quick cash out, and bring it along with their investors. We're all here to support them. So that's kind of like a quick view of what we're doing. And also, if none of them invest in equity, we're not going to invite them next time.
No, I'm glad you mentioned that last point, Tracy. I feel like at the end of the day, you really bet on the founder, and the best founders figure out the right way to accrue value, create the right incentive structures, and drive value across the ecosystem for investors, for participants, for themselves, et cetera. And you bet on the founder just as much, if not more, than you bet on the company, right? So thanks to all the good founders out there. Thank you to our panelists. Really appreciate your time and perspectives today.
Yeah, thank you.
Yeah, thank you, guys.
Thank you.